Welcome back. Now let's look at what is meant by the bid price and the offer price. Bid price is the price a buyer of a security is willing to pay in order to buy the security. Correspondingly, an offer price or ask price is the price a seller of the security is willing to accept to part away with the security. Often traders and investors place orders that specify the bid or offer price and a bid or offer quantity associated with the price. The list of all such active orders is available and updated with the exchange in real time. Often an investor can get a snapshot of top 5 bid prices and top 5 offer prices from the broker just before he places the order. A sample snapshot is shown here. By looking at this snapshot, one can clearly see the highest bid and the highest offer price. So we see here that the highest bid available is at 179.3 and the bid quantity associated with that bid is 100. On the other hand, the best offer currently available is at 179.35 and the corresponding offer quantity is 50. Now let's look at a few examples to understand how the execution of an order placed by an investor will work given this bid offer price quantity situation in the market. So now if these are the available bids and offers in the market and you wish to sell 50 shares at 179.3, you can do so by placing a market or a limit order. If the order reaches the exchange in time and the market bid offer price and quantity does not move in the interim, you will be able to sell your 50 shares at a price of 179.3. Similarly, if you wish to buy 50 shares at 179.35 and you place an order which reaches the exchange in time, you would be able to buy 50 shares at 179.35. Now instead, suppose you place a market order to buy 100 shares and the market bid offer price quantity does not move by the time your order reaches the exchange, you will be able to buy 50 shares at 179.35 since only 50 shares are available at that price, and another 50 shares would be bought at 179.4 as that is the next best offer available in the market at the time. Now we have mentioned the terms market order and limit order here. So now let's look at the various order types that are commonly used in the stock market. Now the purpose of entering any order is to execute a trade in a particular stock or security. The investor enters a buy order in order to buy a security so that he can own the security. Once this order is executed, the investor is said to have a long position. Similarly, the investor can enter a sell order in order to sell a security so that he no longer owns the security. Once this order is executed, the investor is said to have sold the security. However, it is also possible that an owner may not already own a security and yet decide to sell the security so that he can profit if the prices of the security falls. In such a scenario, the investor is said to have a short position. Now there are various types of orders in terms of execution type that are available. This includes market order and limit order. A market order is the most basic type of trade order, which basically instructs the broker to buy or sell the security at the best price that is currently available in the market. When you enter a market buy order, the order will be filled at the lowest available offer price. When you enter a market sell order, the order will be filled at the highest available bid price. The upside of placing a market order is that it is guaranteed that your order will be filled and your buy or sell trade will be executed. The downside is that you won't know at what price you will end up buying or selling a security until the time the trade has been already executed. So for example, if at the time of placing your buy order you see that the stock is trading at 118.7, it may so happen that by the time your order reaches the exchange, the stock has moved to 119, so you might end up buying the stock at 119 instead of 118.7, which was the price you were probably hoping to get at the time you entered your order. So essentially, with respect to market orders, you always face the risk that the market may move adversely by the time your order reaches the exchange for execution. In order to eliminate this risk, there is the option to place limit order. Now, in case of limit order, there is certainty about the price at which you would buy or sell a security. At the time of placing the order, the investor needs to specify a limit price. In case of a limit buy order, the limit price instructs the broker that the order should be executed only if it could be filled at or below the limit price specified by the investor. Similarly, in case of a limit sell order, the limit price instructs the broker that the order should be executed only if it can be filled at or above the limit price specified by the investor. With respect to limit order, while there is certainty about the price at which the order will be executed, at the same time, there is no certainty whether the trade will be executed at all. This is so because by the time the order reaches the exchange, the price of the security may have moved, and so it may not be possible to fill the order within the limit price specified within the order. For example, when you place a limit order with limit price of 100, and by the time the order reaches the exchange, the price of the security has moved to 101, the order cannot be filled as it is not possible to buy the security within the limit price of 100. There is also another type of order which is known as the stop loss order. A stop loss order is used to limit loss on a trade by specifying a stop loss price for an existing trading position. Once the security's price reaches the stop loss price, the existing trading position is closed out by the broker, thus limiting the loss to the investor. For example, if you are long 100 shares of a company A at 20 and you don't want to hold it anymore if the prices fall below 18, in such a scenario, you can place a stop loss order with your broker with a stop loss price of 18. If the prices reach your stop loss price of 18, the broker would automatically sell your 100 shares and close out the position so that you don't suffer further loss if the prices continue to slide below 18. With this, we have completed the basic terminology that you should be aware of in order to execute trades with your broker. Next, what we are going to do is address the topic on how do you go about selecting a broker.